Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Barry Flavin. Barry has been investing in real estate for over 8 years. He started by rehabbing and selling several of his personal residences. He then used the proceeds to purchase over 20 single-family rentals. He has since transitioned into multifamily and currently owns 435 units. So thank you so much for being on the show, Barry.
Hey, thanks for having me, Charles. Appreciate it.
So tell us a little bit about your background, both personally and professionally, before getting involved in real estate investing.
Yeah, so prior to my real estate investing, I went to Western Michigan University, graduated from there in 2005, found myself in a ERP software sales role. It was a great job. Got busy with just that kind of road warrior lifestyle and was looking for a change. And my next door neighbor was an air traffic controller and was always telling me what a great job it was. And I kind of always shrugged them off. And then the 08-09 crash happened and I saw my pipeline go with it and started to think I needed to pivot. And so I said, tell me a little bit more about the air traffic job. And he did. So kind of fast forward, I got hired there a couple of years later and got through the training program there and met my good friend and now business partner, Josh Sterling there. And he's the one that ultimately got me into real estate investing. I watched him build his portfolio from the ground up and started to pique my interest. And I was looking for kind of an additional way to supplement a government pension and healthcare and stuff like that. And thought, man, if I could get a few rental properties, that'd be great. And one thing led to another. And here we are, full-time syndicators.
Nice. So what piqued your interest most about it?
The thing that made the most sense for me was adding to that long-term retirement plan. So as a government employee, most people don't have a pension period anymore, but we had a government pension. Then you also have your 401k, they call it a thrift savings plan, a TSP, you often hear it referred to as. So I thought, hey, if I could get maybe 5 to 10 single family rental homes, but if I buy them now at this point in my life, by the time I retire from the government, I'll have those paid off. And in my mind at that time, I was like, and I'll be all set. Won't need to worry about money anymore. Things will be great. So we quickly started buying a few houses and the light bulb went off for me. And I just saw all the opportunities that real estate has to offer. And we continued to acquire and grow the portfolio. And then that led us into the next progression is multifamily.
Were you buying these turnkey? Were you rehabbing them and flipping them? Were they foreclosed beforehand?
A lot of them were heavy rehabs. We did the kind of the BRRRR strategy. You buy them, rehab them, rent them, refinance them, and we were able to kind of recycle our capital that way for 4 or 5 rounds. We'd buy the house and it would need 20, 30,000 in repairs. We go and put new kitchens. We make them nice. So new kitchens, new baths, hardwood floors, granite countertops, stainless steel appliances. So we would really bring a nice rental property to market for residents in that area. And we would build in the equity by doing that. So when we would go to the bank and then refinance those properties, we were able to pull out all of the cash that we had invested in them. And then in some cases, a little bit more cash we would pull out. And then we would just continue that cycle, buying more houses, fixing them up and so on.
So you've transitioned more into the multifamily now. What was the huge or the main factors that kind of accelerated that change?
So I was looking for just how to scale faster, bigger, and provide even more stability to real estate investing. For me, was just the larger the scale. I always tell folks when they ask me, Barry, how do I start investing in real estate? I want to buy a couple of houses. I always tell people, I said, if you're going to buy some single family homes, set a goal. You got to buy at least 10 of them. Have at least a small portfolio of 10 houses, just so you have that scale where if one goes vacant, you have others that are going to help absorb the impact. Or if you have some major repairs, it's not if you repair a foundation on a house, it's $20,000-$30,000. If you just have one house, that's going to sink you. So I was looking for that scalability, and just continuing to grow. Me and my now partner, Josh, we kind of teamed up where when he started, he got to about 40 or 50 doors and was looking to farm out the property management side to a third party. And through interviewing just different property managers, found that he couldn't outsource it to somebody that was doing as good of a job as he was already. So he said, you know what, heck with it. I'm just going to buy a small office building with some garage space out back. He hired a full-time office person and a full-time maintenance person. And now that property management's grown into 30 people on staff. And I'm a big fan of, like, I'm not trying to reinvent the wheel here. So we teamed up, and I guess the shortcoming on his end was, he said, you know, Barry's like, I don't have kind of network of folks where I can go and continuously raise capital for these larger acquisitions. And he said, your background and your network of folks kind of lends itself to that. So we said, all right, let's do this. You focus on operations. Barry, you go out and focus on raising capital, networking, being the quote unquote investors relation head here. And let's see if we can grow the business this way and just continue to buy good deals that can provide some solid returns.
That's awesome. So you guys self-manage everything yourself from the beginning?
We do. We self-manage everything. It's all in-house.
Yeah, it's interesting because I talk to some people that have self-managed, or they have third-party management and they've moved to self-managing, and it's usually after one or two kind of nightmares, I guess you would say, of PMs, and then moving to self-managing. So you guys had it under one, and gives you a lot more control. What do you think are some of the, other than control, do you feel are some of the benefits for someone taking that in-house?
Yeah, I think the biggest thing is just control. You're able to just react so much quicker instead of, okay, we have an issue over here. Things aren't running the way we want. We need to schedule a meeting with the property management company and just go through that whole process where we're able to drill into our reports at a moment's notice and put our finger on, all right, this is what's not working here. Let's get over there. Here's where we're going to focus our attention today, this week, this month. Here's how we're going to get occupancy up. Here's how we're going to drive a water management project, things of that nature.
Yeah, that's important, because when for third-party managers, I have stuff I own 100% or mainly smaller stuff like that. And it's even with some of our syndication stuff, but it's really that, you're following up on stuff and you're trying to set up with them. Hey, email us when there's an eviction that happens or when there's a vacancy that goes, and you really you have to keep on them no matter how good they are, and finding out where you are. I mean, when you're getting into larger syndications, you're going to have that weekly call, which you can kind of go over this with, but it's nice that you don't have to go that extra distance and be able to, drill down to reports like you said and know exactly what's going on.
Yeah, we still have we have a weekly KPI meeting every Wednesday where we get kind of all the head parties involved, either in the office or on the phone, and we drill into, like, where are we spending money, where are our collections at, what projects are we working on, our turnovers, how many do we have in process. So it's really key, we feel, to have that in-house as you grow. You can do it third party. There's advantages and disadvantages to both, but for us, we found that having it in-house is just it's allowed us to scale much quicker and have a lot of consistency across the board. So every time we acquire a new property, it's as simple as just plugging another box into the main building here.
Yeah, the hard work is starting it up front. And once you have it, then you can scale with it. And I think the other way of attacking that is maybe if you have, 1,000 units or something like this, and you go from the other end where you might buy a place, or where you're like, okay, now we can take on 2 or 3 full-time people, whatever it might be. And, but yeah, the control is the biggest thing, because I don't think it's really, in my experience, it's not a huge profit center, but it is very nice to have the control over your asset.
Absolutely. Yeah. It's kind of a necessary evil. We always say there's the 3 pillars to the deal, right? You got to find the deal itself. You got to find the money to close the deal. And then, often thought of too late in the game, is how are we going to run this deal? Because we're long-term hold folks. We want to keep these assets for 15, 20, 25 years, whatever it makes the most sense for depreciation and tax advantages. So you've got to have a solid team in place and a solid game plan and people that can execute on that game plan and make sure that this thing continues to stay valuable, to continue to generate income and provide the returns and make it a nice place to live for folks.
So your company, New Mission Capital, you're obviously handling a lot of investors, the contact raising money. When you're usually what you have with syndication groups is that, I mean, I guess it's been lengthened a little bit here with COVID last year, but it's usually be like the 3 to 5 year hold, which is now turned into 5 to 7 to 10 year hold. How are you? Because I'm a buy and hold person. Anything I own 100% myself or with JVs, I'm holding forever, as I say. But with syndication, sometimes you're pushed into refinancing, which isn't a problem, but also selling the property and disposing of it down the road. How do your investors react to a long-term hold like that might have a lower return? But it's, I think the longer you hold real estate, the less risky it is. So, I mean, they don't maybe look at that. They're looking at these other returns from other groups.
Yeah. So that is the advantage of the longer you hold it. Time fixes most things when it comes to real estate, because there's no perfect deal. Stuff's going to come up, stuff happens, but the longer you hold that, the less you kind of dampen that impact. But the strategy we have for our investors and the properties we acquire is we go in, we set the right expectation up front with folks, and there's no guarantee that, hey, we might buy this, say we're going to hold it for 20 years. I don't know. There might be a scenario where it comes up and we say, hey guys, it makes the most sense right now to sell this thing after 3 years or 5 years. We haven't done that yet, but to say it will never happen, I can't say that. But so we tell folks our strategy is we want to find and identify properties that we can get into acquire where we can go in, we can add that value. We're either increasing rents, renovating the property to get there, or if it's maybe just below market rents, we're reducing expenses just through better operations. And then our goal is to say after 3 or 5 years, refinance that property. Hopefully we've built in enough value to that, enough equity where we can then refinance out the majority of that capital that was initially put down to acquire that deal. And I think where we might differentiate ourselves a little bit from some of our other fellow syndicators is when we do a refinance on a deal, in a perfect world, we buy a property, somebody gives me $100,000 on the passive side. I'm able to return to them that full amount of capital after 3 years or 5 years. They still own their same percentage of equity that they initially invested in. We don't do any type of clawbacks on the equity side. And kind of the mentality is, it'll take a while to get there, but we're building this soon to be kind of runaway snowball of capital where I know if I was on the passive side and somebody was able to, heck, even if they gave me back half of my money after 3 or 5 years, that's still great. So I'm going to turn around and say, hey guys, here's some more money. Go find another one. Let's just keep stacking these.
Yeah. And then they have less volatility in their portfolio because now they're part of more units. And I think with the more units you have, less volatility, especially we saw with COVID, right? Where you might say overall, we have, 96% of people paying, right? Well, I might be in that asset you just bought 2 months ago, right? Before COVID, and we might be in the high 80s, right? On the occupancy or economic occupancy. Now, if I was spread over more, overall, we're now talking mid 90s. So I feel that's another great way of limiting everybody's risk on all portions of the syndication.
Absolutely.
Yeah. So you work a lot with investors. So communication with investors is usually a difficult thing to gauge. And like sometimes, we're going to send out our monthly report. We're also I'll send out some short updates. How do you guys gauge what's too much, what's too little when you're handling communication with your investors?
Yeah. So kind of two different scenarios. There's the acquisition phase where a little bit more communication is required. We'll go there saying, but once we've closed on an asset and we're starting to put our plan in motion, we do quarterly updates. And then we also do a mid-quarter update. We do quarterly distributions as well. And we kind of pride ourselves on our transparency. We try to tell everybody everything that's going on. Some people, they won't even read our updates. Just, all right, guys, just send me the direct deposit every quarter. Don't care. Do a good job. And then we have other folks that they want to know everything that's going on. They want to know what kind countertops we're putting in, or what kind of flooring we put down, and how much we spent on each item. So, and we'll go there for people. We'll tell them exactly what's going on. We tell them the good, the bad, the ugly. And we've gotten a lot of positive feedback from the investors of, hey guys, we really appreciate you not trying to hide and sugarcoat things. Stuff's going to come up. There's no perfect project, right? And on the acquisition side, because things develop, right? We're working on a deal right now where we put a small portfolio together, and it was originally 3 properties, and on the third, we had closed the first 2, and then the third one, we're a week out from close, and the broker calls and says, hey, there's a big problem here. They didn't disclose all types of collection issues and litigation issues. So we went to him and said, well, this changes the deal. We want a price reduction of X, or we have to move on. So they didn't want to negotiate. So we had to move on, and we reconfigured the deal. So now it's a 4-property portfolio investment for our investors. So a lot of communications, just a lot of moving parts, right? And the main source of communication is sending out the emails to the appropriate groups. And then just on a more local level, we started with the friends and family network of investors. So I see a lot of folks around town, always happy to meet up face to face for coffees, lunches, dinners, rounds of golf, et cetera. So
yeah, it's interesting. I have some investors that will never respond to us by email, but I'm like, I don't even know if you're reading this, what's going on, and I have some that ask for the cost segregation report, and you're like, okay, it's 150 pages of light reading. If you're interested, I'll send it over to you.
Let me know if you can interpret that.
Yeah. I was like, if you want it, I mean, it'll be in a K1, but whatever you like. And so you talked a little bit about raising capital. What have you found to be the best way of raising capital over your career?
I've found the most effective way is, we started out with that friends and family network of folks, and I find the best way is we're just slowly growing that from the center out. We do a good job for folks, and then when we come up against a project where we need to go find some more money, we ask for referrals, and we try to. That's been the best way. We've kind of grown that way.
Yeah, referrals are definitely the best way. I mean, you can't get any better that way. I mean, no matter how many podcasts you're on or whatever you do, I mean, it's still the best way of doing it when you have someone that's singing your praises, that's recommending someone.
Exactly. I enjoy jumping on podcasts like yours, and been on some others, and we do have folks that reach out to us, and we're always happy to share how we might be able to align ourselves with what they're looking for investments, and kind of what our target assets are and our strategy. And sometimes it fits, sometimes it doesn't. But we found the best success rate is just talking with folks more local here, closer reach, I should say.
Yeah. Awesome. So you guys are a little bit more vertically integrated. What kind of systems and processes or systems and software do you guys utilize daily?
So on the property management side, we use Buildium as our main day-to-day operation system. And then we went and developed kind of a front-end custom piece of software where we had some developers come in and help us design this from the ground up. And it's just really allowed us to tie a bunch of those little systems together and give our folks out in the field just the tools they need to get to a job. They'll have iPads where they log right into our system. They pull up, hit the start button. I started working on this job. I completed this job. They can enter all the notes so that that's all immediately feeding back to the folks in the office. So it is seamless, just minute to minute communications. And then on the investor side, we use IMS now, RealPage, for our investor portal. We communicate a lot that way. Our direct distributions go out through that. Folks can log in at any time they want and do a deeper dive into what their investments are looking like.
Interesting. That's awesome. That's great to have that with the app when they show up at your property. So then you can really gauge the amount of time spent at every asset. Yeah.
And we could go into the weeds on that. You should have my partner, Josh Sterling, on the line. I mean, you guys can go into the weeds on property management.
So what mistakes do you commonly see real estate investors make over your decade of residential and multifamily investing?
Gosh, the biggest one I would say is probably just getting caught in the analysis and just not putting that first foot forward and taking action and actually doing it. People just get hung up on I'm waiting for the market to level off. I'm waiting for the market to crash again. There's no perfect time. There's no perfect deal. It's, you just got to get moving.
Okay. Yeah, I totally agree with that. There's going to be doubles and there's going to be triples and home runs and grand slams. And you can't wait for just a grand slam to come around or you'll never get started.
Exactly. You still have to be disciplined. You still have to stick to your criteria, which is getting harder and harder these days. People are. Oh yeah. Another mistake I see, I could be wrong, but I see a lot of people overpaying for stuff right now. We kind of scratch our heads. We analyze a lot of deals and we just, we let them keep going by. And I said, I don't know how somebody's paying that much, but
yeah, we have two potential deals that one of them is just went hard on and the other one we're looking at. And I couldn't believe it. What they're selling for or what we're possibly selling this property for. I would never pay anything. I would pay probably 20% less. I mean, it was just completely crazy what's happened especially in really hot markets around the US.
Yeah, we routinely see that we'll talk to the brokers and like, all right, we can we'll offer 5. And they're like, well, we already have offers at 7.5 or 8. And we just snap our heads and we're all right, well, call us on the next one. So
yeah, no, for sure. Well, I mean, that's something where I think when I was talking to someone before, not to get off on a tangent, but when I've been investing since 2006 and when we were self-managing our properties like in 2007, 2008, 2009, and you have a little bit of a pullback, but it was interesting when I was talking to someone, people I worked with in 2006 buying properties, they weren't even in real estate in 2008. You know what I mean? And I don't know the perfect percentage, but it was like 80% of people when I look back on it, they're investors, agents, lenders, whatever they are. It's just when there's this pullback that happens, and that was a huge pullback. But when that pullback happens, I mean, it shakes up the whole thing on all sides of it. And, when you're buying in 2009, brokers are calling you trying to sell you stuff. Now you're trying to get someone on the call and they're not picking up because they've got someone at 7.5 when you're at 5.
Yeah. We just kind of keep underwriting and operate on the mentality of, all right, I can't wait to buy it from the bank in 5 years because I think what's happened a lot is interest rates have been low. You have that much more buying power. COVID definitely highlighted how stable multifamily was during all of this. I think a lot of that office space money, East and West Coast money, people are now looking for more stable, reliable places to put their money. And you have it's kind of a long run of such upward pressure on rents, and it has to level off. You can't continue on this trend of rent growth. It's great for the stuff that we own, but I mean, I think there's a lot of people out there that are buying with the expectation of we're going to continue to see 5, 6, 7% rent growth year over year. And when it stops, I think there's going to be a lot of people in a tough position. So, yeah. When someone sends me their underwriting, that's usually one of the first things I look at to see. Secondly, if they've updated their real estate taxes, but the second thing is to see what they are predicting for rents and when they think they're going to go into effect. Because if you think you're going to move it right to market rent or what you think is market rent right off the bat, I mean, you're sadly mistaken. Yeah, it's going to take you 2-3 years to ramp up to, if it's a $200-$300 difference, and from what you're getting to where you could be, it's you don't just buy it, flip the switch and get there. Yeah. And like you said, on taxes, it's always such a wild card. I mean, we always err on the side of caution. We always factor in a 2, maybe 3% rent growth factor. And we do our best to analyze the taxes, but we always throw in more than we probably should there just because. Well, you have no idea. You have no idea what's going to happen coming forward. And I mean, that is a huge expense. No matter what your debt's fixed at, your real estate taxes and your insurance are not. So it's definitely something that you have to keep mindful of that will increase as rent increases as well. Certainly. But, what are the main factors that have contributed to your success, Barry? Main factors, I guess, 2 things. One, being consistent and transparent in all things that we do. And then for me personally, the biggest thing in the real estate side was taking action, and then also partnering, finding the right person. My partner and buddy Josh Sterling, where we had those complementary skill sets. And I say, I'm not trying to reinvent the wheel. He does a great job on the operations, the property management side of things. And from day one, when I bought my first rental house, I said, I only really want to start down this path if I can buy them and have you guys manage them. Mm-hmm. So this is before we even started talking about partnering up, where we would buy the houses, we'd clean them up, and I would give those guys the keys right away. I would literally walk from the closing, go over to his office, drop the keys and everything that they had, and say, here, start fixing them up. And I was able to free up my time to go out there and start looking for more opportunities.
Awesome.
And then when we decided to team up, for me, it was kind of like a no-brainer to say, hey, you have the operations down. I do not want to go and create my own property management company, or if I found myself in a position where I could acquire a property, say a 30, 40, 50 unit, mm-hmm. if he couldn't manage it, I wasn't looking at it because I just didn't want to go through that hassle.
Yeah, for sure. You already have that system in place for property management. And then you get a little bit more scale. Every property that you add in, like you were talking before, to have 10 properties. And that's a huge thing. Even if someone's buying a multifamily property, I always say, even if you're buying smaller multifamily, 3s or 4s, make sure you have that goal in 2 or 3 years to, if you want professional property management to handle it, that you're getting to 10, 15 plus units. And then that way you can get some scale and you're not paying somebody 10% to manage them. And mm-hmm. You're paying every fee here and there for everything. I mean, you get a little bit of scale if they're somewhat close together, and and you can have the same person manage them.
Yeah.
But how can our listeners learn more about you and New Mission Capital?
So as far as getting a hold of me, the best way to get a hold of me is Barry@newmissioncapital.com. They can also find our website, just newmissioncapital.com. We're on Facebook and Instagram, but probably not as active there for the business side of things, but you can get a hold of us there.
Awesome. I will put all those links into the show notes. So thank you so much for coming on today, Barry.
Hey, appreciate you having me, Charles. It's been great.
Talk to you soon.
All right.
Hi, guys. It's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.